Welcome to the deep dive. If you've ever watched financial markets, it can really feel like, well, total chaos sometimes.
Oh, absolutely. Prices jumping all over the place.
Exactly. Up, down, sideways. It often seems like there's no logic, no reason behind it, just pure randomness.
hmm
But what if even inside all that seeming chaos, there are actually underlying patterns, whispers of order?
And what if traders had tools based on some pretty old mathematical ideas to kind of anticipate those moves?
That's exactly where we're headed today. It's not about predicting the future perfectly, is it?
No, definitely not. It's
Yeah.
more about finding these zones, these areas
Mm.
where the market is more likely to react, to
Mhm.
pause, maybe turn around,
Yeah.
or just catch its breath before continuing.
Fascinating. And today, our mission, our deep dive, is focused on one of the most, well, intriguing tools out there, Fibonacci retracement.
Ah, yes. Good old Fibonacci.
We're going to unpack this thing, look at where it comes from, its roots in nature and math, which is pretty wild,
Right.
and then see how traders actually use it on their charts to try and predict those market pullbacks.
We'll cover the core idea, those key number levels everyone talks about.
Show you how to actually draw it, apply it, and maybe just as important, talk about where it doesn't work, its limitations.
Definitely need to cover the caveats.
Okay, let's get into it. So let's unpack this first. We often hear this idea that markets, even when they're strongly trending up or down, they don't just go in a straight line, do they?
Not at all. They breathe. They move in waves. You get these pullbacks or bounces, little counter moves against the main trend.
Right, like if something shoots up, it often dips back a bit before going higher. From a peak, what traders call a swing high, down towards maybe a swing low point.
Exactly. And that's precisely where Fibonacci retracement comes into play. It's a technical analysis tool specifically designed to help traders spot potential support and resistance levels during those pullbacks.
And it's based on,
It's all built on the Fibonacci sequence, that famous number pattern, 1, 1, 2, 3, 5, 8.
oh yeah, the one you see in like pine cones and seashells?
That's the one. It
Yeah.
pops up all over nature, mathematics, and, yep, finance too. The core idea here is using ratios derived from that sequence to estimate how far a price might retrace or pull back before hopefully resuming the bigger trend.
So it helps with timing, like knowing when to jump in.
Exactly. It helps traders try to time entries, figure out where to place their stop losses, to manage risk, and sometimes even set profit targets. It's all about gauging that pullback potential.
Okay, this is where it gets really interesting for me. These numbers, the percentages people use, they aren't just pulled out of thin air, are they? There's something fundamental behind them.
Oh, absolutely. They're derived directly from the relationships within that Fibonacci sequence we just mentioned.
Yeah.
Although one popular level isn't technically a fib number, but we'll get to that.
Okay,
So you start with 0.0%. That's just the beginning of the move you're measuring, your starting point.
makes sense.
Then you have 23.6%. This usually represents a fairly minor pullback. Think of it as the market just taking a quick breather.
Okay, a shallow one.
Right. Next up is 38.2%. This is often the first key level traders watch. It's a more significant retracement, a potential zone for support in an uptrend or resistance in a downtrend.
Got it. And the one that's not technically a fib number?
Ah, yes. That's the 50.0% level. It's not derived from the sequence ratios like the others, but it's incredibly significant psychologically.
Why is that? Just because it's halfway?
Pretty much. Humans seem drawn to that halfway point, that sense of balance or equilibrium. So many traders watch it that it often becomes important just because people expect it to be.
Interesting, like a self-fulfilling thing we'll probably talk about later.
Exactly. Then we get to probably the most watched level of all.
Which one is that? If there's one number to really know.
That would have to be 61.8%. This is the famous golden ratio, or phi. It's considered the strongest, the most significant potential retracement level.
The golden ratio, I've heard that mentioned with like art and architecture too.
You have. It appears all over the place. Proportions in ancient buildings, patterns in plants, even the structure of DNA, some say, is almost like this fundamental ratio of natural proportion. And markets, strangely enough, seem to respect it quite often.
Wow. Okay, so 61.8 is key. What else?
After that, you have 78.6%. This represents a much deeper pullback. Some traders see this as kind of the last line of defense for the trend. If price breaks decisively below this in an uptrend or above it in a downtrend, it might signal the whole trend is reversing.
So a really deep correction.
A very deep one.
Mm.
And finally, you have 100%, which, well, means the price has retraced the entire moves you were measuring. So the trend you were tracking has effectively been canceled out or fully reversed at that point.
Understanding those percentages seems absolutely crucial then. Okay, so we've got these key percentages, these levels, but how does someone actually put this into practice? Like, if you're looking at a chart right now, how do you draw these lines? What's the process?
Great question. And the good news is it's actually pretty straightforward with modern charting software. Let's take an uptrend first.
Okay, market's generally moving up.
Right. So first, you need to identify a significant swing low, that's the bottom point before the upward move started, and a swing high, the peak of that move so far.
Lowest point to highest point of the wave.
Exactly. Then you select the Fibonacci Retracement tool on your platform. You click on the swing low, drag your mouse up, and click on the swing high.
Click low, drag, click high. Got it.
And boom. The software automatically draws the horizontal lines at those key percentages we just talked about. 23.6, 38.2, 50, 61.8, 78.6, between that low and high.
And then you just watch the price?
Then you watch as the price starts to pull back from that high. You're looking to see if it finds support, if buyers step in around one of those levels, especially the 38.2, 50, or 61.8. Those become potential bounce zones.
Okay, and what if the market's heading down, with a downtrend?
You just flip it. Identify the swing high, the peak before the downward move, and the swing low, the bottom of that move.
High point to low point this time.
Correct. Grab the Fib tool again, click on the swing high, drag down, and click on the swing low.
High to low, okay.
The levels appear again, but this time, as the price bounces or pulls back upwards slightly within the downtrend, you're watching those same levels, 38.2, 50, 61.8, to act as potential resistance, places where sellers might step back in to push the price lower again.
So potential ceilings in a downtrend.
Exactly. And like I said, pretty much any decent charting platform, TradingView, Thinkorswim, Webull, whatever you might be using, they all have this tool built right in. Makes it super easy to apply.
All right, so the lines are on the chart. What are traders actually doing with them? How do they translate into like buy or sell decisions?
Well, they use them for a few really key things. First off, entry points.
Okay.
So in an uptrend, if the price pulls back to, say, the 50% or 61.8% level and starts showing signs of bouncing, like maybe a bullish candlestick pattern forms right there, a trader might decide that's a good spot to buy, anticipating the uptrend will continue.
Betting on the trend resuming from that level.
Precisely. And conversely, in a downtrend, if price rallies back up to one of those levels and looks like it's hitting resistance, a trader might initiate a short position, betting the price will fall further.
Makes sense. What else?
Stop loss placement is another big one. Risk management, right?
It's crucial.
So if you buy at the 50% level in an uptrend, you might place your stop loss order just below the next level down, say the 61.8% level. The idea is if it breaks that deeper level, your trade idea might be wrong and you want to limit your loss.
Kind of a built-in boundary for your risk.
Exactly. And third, some traders use them for take profit targets, though this often involves combining them with Fibonacci extensions.
Extensions, that's a different thing.
Yeah, related but different. Retracements measure the pullback within a trend move. Extensions project potential future price targets beyond the initial move, using similar Fib ratios, like 161.8%. So you might enter at a retracement level and target an extension level to take profits.
Could you maybe give us a quick, concrete example, just with some numbers?
Sure. Let's imagine a stock makes a nice run up from $100 to $150. Clear uptrend move.
Okay, $100 low, $150.
Right. So you grab your Fib tool, you draw from a $100 swing low up to the $150 swing high. The platform would then calculate the levels.
What would they be, roughly?
Well, the 38.2% retracement level would be around $130.90. So $150 minus 38.2% of that $50 move.
Okay.
The 50.0% level would be right at $125 halfway back.
Easy math on that one.
Yep. And the important 61.8% level would be down around $119.10.
Got it. $130, $19.10.
Exactly. Now, let's say the stock peaks at $150 and starts to pull back. If it comes down and touches, say, $125, that 50% level, and you start seeing maybe buyers stepping in, volume picking up, maybe a nice-looking candle pattern.
That could be your signal.
That could be a signal to consider re-entering the trade, buying there, with the expectation that the pullback might be over and the uptrend towards perhaps new highs could resume.
This all sounds incredibly useful, almost elegant in a way. But you hear this a lot in trading. There's no magic bullet, right? It can't be that simple.
Yeah.
What are the big caveats, the things people absolutely need to remember?
Oh, absolutely a crucial point. You're spot on. Fibonacci retracement is definitely not a standalone strategy. Using it in isolation is generally a bad idea.
Okay, so don't just buy blindly at a fib level.
Please don't. Think of it more as a a potential area of interest, a zone where you should pay closer attention. It works best when you combine it with other forms of analysis for confirmation.
Like what other tools work well with it?
Several things. Price action is huge. Are you seeing actual candlestick patterns like a hammer or an engulfing pattern forming right at that fib level,
Hmm.
signaling a potential turn?
So the market's behavior at the level itself.
Exactly. Also look at volume. Does volume increase as price hits the level and bounces? That suggests stronger conviction behind the move. Momentum indicators like RSI or MACD could be great too. Are they showing divergence? Like, is price making a lower low, but the indicator's making a higher low as it hits a fib level? That's a classic positive sign.
Combining different signals for more confidence.
That's the key, confluence. You can also look for fib levels lining up with other support resistance tools, like established trend lines or maybe moving averages, like the 50-day or 200-day EMA. When multiple things point to the same level, your probability increases.
Okay, so use it as part of a bigger picture. Any other big warnings?
Yes, one really important one, market conditions. Fibonacci retracement is designed for trending markets. Clear uptrends or clear downtrends.
What about when the market's just chopping sideways?
Yeah, in sideways, choppy, or consolidating markets,
Right.
it becomes much less reliable. The levels don't tend to hold as well. You get a lot of false signals. So rule of thumb, identify a clear trend first, then apply Fibonacci retracement to look for pullbacks within that trend. Avoid it in range-bound markets.
Okay, so putting this all together, why does this even work? Is it some kind of, I don't know, mystical property of these numbers aligning with markets? Or is there a more down-to-earth, maybe psychological reason these levels seem to matter?
It's likely a combination, but the psychological component is probably the biggest driver, honestly.
How so?
Well, think about that self-fulfilling prophecy idea we touched on earlier.
Right.
Because so many traders, analysts, and even automated trading algorithms
Mhm.
are aware of and actively watching these specific Fibonacci levels.
Their collective actions make the levels significant.
Precisely. When price approaches a key level, like 61.8%, a huge number of market participants are anticipating a reaction there. Buyers might place orders just above it. Sellers might place stops just below it. This concentration of orders around the level can itself cause the price to react.
So it works partly because everyone believes it works.
That's a big part of it, yes. There's also the element of basic human psychology, fear and greed. These levels often coincide with points where these emotions might naturally kick in. A pullback to 50% might trigger fear in some, prompting selling, while others see it as a buying opportunity driven by greed or the fear of missing out. These natural human tendencies can often cluster around these mathematical points.
And you mentioned algorithms.
Yeah, that's increasingly important. A lot of modern trading, especially institutional trading, is driven by algorithms. And many of these algos are specifically programmed to recognize and react to Fibonacci levels, adding another layer of automated buying or selling pressure right at those zones.
That makes a lot of sense. The human and machine element reinforcing each other. Now, you mentioned extensions earlier. It sounds like Fibonacci is more than just these retracement levels. It's like a whole family of tools.
It really is. Fibonacci ratios pop up in a surprising number of technical analysis techniques. As we said, Fibonacci extensions are commonly used alongside retracement, but their job is to project potential price targets forward, beyond the initial swing high or low. They help answer the question, where might this move go next?
So retracements for entries, extensions for exits, maybe?
That's a common way people use them, yeah. Then you have things like Fibonacci fans and arcs. These